Welcome to Resilience and Resolve with Lance Drury.
Welcome back to Resilience and Resolve with attorney Lance Drury. Lance has spent more than 30 years helping individuals and small business owners resolve serious IRS tax problems. I'm Evan Mack, and today we're talking about how IRS enforcement can look different when taxes involve a business. In some situations, the IRS focuses on business assets rather than personal ones, and understanding that distinction can help business owners better navigate tax problems. Lance, my brother, welcome back.
How you doing, Evan? Good to see you again.
Good to see you too, Lance. So, when a business owes back taxes, how does the IRS decide whether to pursue business assets instead of the owner's personal property?
Well, that's not really the choice the IRS has. If they're incorporated or
Okay.
you're an LLC, they're going to go after the business assets. They're required to do that. Now, if you're a sole proprietor, that flows through your 1040. You have to go after the personal assets because you don't have a separate legal entity to protect your assets and shield them from creditors. So they're going to go after the business in the first instance. And so here's the thing, though. If you owe back payroll taxes and the IRS can't get the monies, all of it out of the business, they can do what's called a trust fund civil penalty interview. None of my people go to that because you're basically admitting that you're guilty of a felony because the statute tracks identically to the federal statute for tax evasion. So I'm not going to send my client in there to confess to a felony. So they always know in a small business who the owner is, who runs the business, and the owner should have known the taxes weren't being paid, even if he doesn't. So they can get him because that's his fiduciary obligation to know that. So that's the only instance then after that interview, they can then go after personally your assets and your income, but only the trust fund portion, which is about 50 to 60% of the total payroll tax. It's the portion attributable to the employee. So that's when that happens, is if there's unpaid payroll taxes. But if you're talking about business income taxes, they can't come after you personally for that. It's only if there's unpaid payroll taxes, then they can go after your personal stuff.
What types of business assets are most commonly targeted, though, when the IRS begins collecting unpaid business taxes?
You know, I have never seen them really seize anything other than the norm, which is going after their bank accounts. They will also send out notices and try to intercept their accounts receivable. They'll go after people that owe them money and target them. But if you don't have a recurring clients, depending upon the business you're in, let's say you're a painter and you get everybody and it's always different, they're never going to get any money going after your client because they don't know who they are until after the 1099 is
Yep.
recorded. And then if you don't use them again, they're not going to know it. But they will go after people who have recurring clients, and they will go after that. And that can really destroy a business because those people don't want to bring you their work anymore. They don't want to have to deal with all that. They don't want to have to do the paperwork to send in the money to the IRS. So that's the problem there, Evan.
How does the IRS approach enforcement directly when the tax debt is connected to the payroll taxes or other business related obligations?
Well, they will most definitely, their highest priority is payroll tax. And what they really frown upon, and I know this because I was at a conference and a person from the IRS spoke, that is one of their biggest priorities. They do not want a business to keep pyramiding payroll tax liability. So what they're going to do is they're just going to shut you down. If you can't pay your bills and your tax debt is one of your bills, they're going to say you're not a viable business and they're going to just want to shut you down because they're not going to want you to keep pyramiding liability because they're losing that money that's based on the employee social security at the end of the day. So you really got to watch that. You've got to stop that hemorrhaging. You've got to start becoming compliant. People think owning your own business is the American dream. Well, a lot of
Mm.
people, they have never been taught all the things that you are required to do if you own your own business. It's a lot of paperwork. And the last thing people want to do when they get home from work at 7, 8 o'clock at night is to do paperwork. or they don't understand all the paperwork that needs to be done. So if you're going to go into
Mm.
small business, you've got to learn to do the work. And most small businesses are not that profitable. And it's long hours. So you got to do the work. You got to be compliant. You got to stop the hemorrhaging because we're not going to get you a deal. And if you do get a deal, the deal is going to go down the drain if you don't be 100% compliant moving forward, which means you got to pay those taxes on time and you've got to file on time.
Many business owners assume their personal finances are completely separate from their company. Why can that assumption sometimes lead to problems with the IRS?
Well, you should keep your personal accounts separate from your business. And the reason is, how do you know how profitable you are if you're putting personal
Mm.
income into that account or you're paying personal bills from that account? You don't know how viable the business is if you're doing that. And the other thing is, it makes it easy because you can look at that account on the first day of the month, see how much is in there, look at that account on the last day of the month, and know how much money you made for the month. And the other problem is, if you try to get an agreement with the IRS when you don't segregate the personal from the business, you're going to have a hard time getting a deal out of Uncle Sam because they're going to give up sometimes and say, I can't figure out if this is a business expense or if this is a personal expense. So I'm not giving your client a deal. So the first thing I tell people when they come to me and they don't have a separate business account is you've got to set up a separate business account and keep it clean.
Lance, you have a situation you can recall, where understanding how the IRS viewed the business changed the strategy for resolving that tax debt?
I don't know that I have ever encountered that situation, Evan, off the top of my head. Um, I just don't know what to tell you about that one.
When the IRS focuses on business assets, how can that affect the company's day-to-day operations, Lance?
Well, it can hurt them. You know, if there's a levy out there and it's on your bank account, it's going to hurt your ability to keep the business going. If they're going after the people that owe you money and they're levying those funds, it's going to hurt your ability to keep the company going. This is why you have to keep it clean. You've got to pay your taxes on time and you've got to file on time. That is the number one thing a business owner has to do, or you're going to fall into deep trouble with the IRS and they're not going to mess with you because, Evan, compared to income taxes, business taxes can get to six figures awfully quick. Look at all those payroll taxes. So it's not uncommon for a business owner to have over $100,000 in IRS tax liability. But it's pretty hard for somebody for their personal income to reach over 100,000 in income tax liability for themselves. So, it just gets out of control and you can't do that, and it's not always the business owner's fault. Sometimes somebody went it belly up on them. This is why I get my money before I get a resolution, Evan. I tell these guys, and every small business owner understands why, because people have gone belly up on me once the case is completed. They don't pay their bills. And so I make it a rule that we're not getting you a final resolution till the bill's paid in full. And this is what happens to business owners. Somebody doesn't pay their bill. And so to keep the business going, they pay their suppliers, they pay their employees. They think they're going to catch up the next quarter on payroll taxes with Uncle Sam. And then it just kind of snowballs and then it just gets totally out of control.
In what situations might the IRS eventually shift attention from business assets to the personal finances like we were talking earlier about?
Yeah, well, I think I illustrated that situation earlier, particularly. The biggie is
Yeah.
with payroll taxes. Then they can come after you for a portion of the payroll tax. They normally do that when you can't pay the complete tax. But here, it's not an additional tax, Evan. So if you get the trust fund to cert it, which is 50 to 60% of the total payroll tax, for every dollar you pay down the trust fund, and we normally tell people to pay the trust fund down first to insulate their personal assets and their personal income from seizure by the IRS. Guess what? For every dollar they pay down on the trust fund, a dollar goes away on the payroll. So it's not like it's an additional tax. It is an additional tax in the sense that it's separate, but it doesn't increase the liability on either end.
What mistakes do business owners make when they try to keep their business running while dealing with these unresolved tax issues, Lance?
Well, the biggest problem, it's twofold. They try to do it on their own. They get a revenue officer. They get a 9297, which is a summary of taxpayer contact. They think they've given the IRS all the financial information that they have. Well, they don't, and then they get levied. And they'll tell us, well, I gave them everything that they asked for, but they didn't give them everything that they asked for because it's confusing, it's complicated to the average individual, and that happens all the time. The other mistake that people make, they think they can do it on their own and they don't want to get levied, so they call up the IRS, they set up an agreement. It's always for the full amount because the IRS doesn't tell them how the game's played. The game is played, but it's all
Yeah.
based on your ability to pay it back. But they take advantage of lay people. So they set that all up, they make that payment, but then they can't make their estimated tax payments on the year. And so they incur further liability and it just gets higher and higher. So here's what you got to do. I'm giving everybody out there free advice today. What you got to do is you've got to start paying the estimated tax payments first before you set up a deal with Uncle Sam on the back taxes for two reasons. It stops the hemorrhaging moving forward. And secondly, those estimated tax payments are an allowable expense in determining your ability to pay on the back taxes. So let's say you're sending in $1,500 a month on estimated tax payments. That's $1,500 less a month you got to pay on the back taxes. I had a client once. If he would have sent in $1,000 a month on $60,000 tax debt and started making his estimated tax payments so he was compliant moving forward, he would have paid nothing on the back taxes. But he didn't do that.
Wow.
He refused to do that. And then him and his wife got a divorce, so we kept her and not him. And we could tell,
Wow.
we no longer have access to his information, but the payments on the account will show up on hers because it was joint liability. So we know he was making payments. If he had hired us, we would have run out the clock and he wouldn't have paid a dime, but he didn't do that. He thought he could do it on his own. You got to pay attention to when the clock runs out on collection as well. That's a biggie, Evan. We can run out the clock maybe 10, 15% of the time, and we've saved millions of dollars doing that for taxpayers over the years.
So for someone listening who owns that business and is facing IRS pressure, what should they understand about how this enforcement may unfold, Lance?
Well, they could destroy your business, or they could make it extremely difficult for you to continue in business. They could, go after you, the people that owe you money, and those people don't want to do business with you anymore. So they can wreak havoc on your business. So here's the thing you need to do. You need to get professional assistance. Call us. Go to lancedrurylaw.com. We have offices in St. Louis, St. Genevieve, Missouri, Nashville, Tennessee, San Antonio, Texas, and now Houston, Texas. And we hope to have more, Evan. It's the hostile takeover. And so anyway, call us.
I
We'll
told
have
you.
a free.
I told him.
We'll have a free half-hour consultation.
I told him, Lance. I told him, y'all better get ready for the Lance Drury wave. I told the people.
But that's what you got to do because you can't
That's
do
it.
this on your own. All of my attorneys spend 50 to 100 hours a year or more keeping up with this. When I was a regular small town lawyer, it was 15 hours a year. Everything is constantly changing at the IRS, and it's worse. The IRS is worse than I've ever seen them. The only thing I can say is as bad is the Postal Service. They don't have enough employees. They're not properly trained. Everything is taking forever to get resolved. So get professional assistance.
Yes, indeedy, Lance. Thank you for your time, brother.
Thank you, Evan. It's always a pleasure to be here.
Thank you for listening to Resilience and Resolve with attorney Lance Drury. IRS tax problems involving a business can quickly become complicated, especially when that enforcement actions begin affecting company assets. If you're dealing with IRS issues connected to your business and want guidance before things escalate further, you heard the man. Visit lancedrurylaw.com. Don't forget to like, subscribe to the show, and leave a review if you found this episode helpful. We'll see you next time.
Thanks for watching. Be sure to hit that like and subscribe button and leave us a review in the comments.